Okay, so this is a walkthrough of interest rate options, how to price them, how to use them for hedging purposes. And if we're going to learn about how to use these for hedging purposes, we should first take a look at how they are priced. So the payoff of an interest rate call, the payoff of an interest rate put, when it comes to options, are a little bit different than when we're looking about interest rate options on futures contracts. With a interest rate option, we're looking at not in terms of prices, but in terms of rates. So the profit will be based off of two interest rate differentials. We still have an exercise rate or an exercise price and the price of the underlying. It's just that these two are interest rates instead of prices. So, for example, we might have an underlying rate of 8%, and this underlying rate will be something like a benchmark rate like LIBOR, or more recently SOFR, the secured overnight finance rate. It's just some benchmark interest rate corresponding to where interest rates are at the time in the market. And then because this is an option, we'll also have an exercise. In this case, it's an exercise rate, not an exercise price, and it's the price at which we can sort of lock in using this interest rate option. And like all options, if this component of this is not favorable, if the underlying rate, if LIBOR ends up below the exercise price, then for this call option, we can just walk away from it. And we'll be out the premium, but we won't be any worse off. And the payoff of the put is just the inverse of that. Like all options, the payoff of the call is the opposite of the payoff of the put. So the only difference that we have is that these two components are reversed. One final thing to note is that interest rate options come in different maturities. So you might have an interest rate for a year, you might have an interest rate option for 2 years, or you might have something for 6 months, 180 days. And the reason why that matters is that these rates here are quoted in terms of annual terms. And since your entire option may itself not be annual, it may be a 6-month option, it may be a 2-year option, we adjust these annual rates by this exponential factor here. The number of days for the option until expiration date divided by 365. So it's one unique adjustment that we have to make to interest rate options that we don't have to make for other options. Okay, with payoffs described, we can then talk about how we can use these types of contracts to reduce risk of interest rate risk. And the biggest type of interest rate risk that a company typically faces is that of variable rate loans. You can get loans that are linked to something like LIBOR. And that means whatever you pay over each period in which you make an interest payment is going to depend on what LIBOR is at that time. So it's a variable rate loan because you don't really know what the interest payment is going to be over the next payment period. It depends on whatever market interest rates are doing. And so people like entities like variable rate loans because on the one hand they are riskier because you could pay something higher or lower. You just don't know what you're going to pay as an interest rate. It just depends on what markets are going to do. However, the benefit for that is that because you take on more risk and the lender takes on less risk, they can be cheaper. They can offer you an interest rate that is lower than what currently fixed interest rates are offering right now. And so that's the appeal. So one thing, though, is that we can get rid of some of this risk with an interest rate option. We can still get a variable rate loan. We can borrow money and pay back interest that depends on LIBOR, but we can cap our interest rate exposure. That is, if LIBOR goes very high, we can prevent severe costs and consequences from that situation. So it turns out that if we have a variable rate loan, well, first of all, if we had a variable rate loan and we had zero derivatives, we were just having simply a variable rate loan, that's what this yellow line would look like. That is, the cost of our loan would depend just straight up on the benchmark rate. As the benchmark, whether it's LIBOR or SOFR, goes up, so does the cost of our loan. But the key idea with an interest rate option is that we can still have the benefit of a variable rate loan if interest rates fall, but if they go too high, we can cap the amount of interest rate that we have to pay, and if they continue going higher, we are still capped. So they can allow you to enjoy lower rates, but also cap your rate exposure. And so a borrowing strategy that uses a variable rate loan, but also uses an interest rate option to hedge it, has a sort of realm of possible interest rates that you'll pay in total that looks like this. And when it comes to hedging, one thing that we need to note is that with a interest rate option, when you're trying to hedge against an interest rate rise, this is where it would be more expensive to you because you have a loan linked to LIBOR, and what you might pay is whatever LIBOR is plus a certain amount, it's basically a credit spread based on the risk of you as an individual borrower. But that stays fixed, and whatever LIBOR is, if LIBOR changes, so does the cost of your loan. So the risk to you is that interest rates rise. If that happens, if LIBOR goes from, say, 5% to 10%, then the cost of that loan that you have now goes up as well. And so we need something to hedge against this. We need something that pays off when interest rates rise. And when it comes to interest rate option contracts, that type of thing is a call. This is a little bit different than an interest rate futures contract. With an interest rate call, if the underlying interest rate, LIBOR or SOFR, rises above whatever strike rate we choose, then that's when a call pays off. So a call actually pays off when interest rates rise. And that's exactly the type of scenario we're concerned about here. So if we have an underlying loan that's variable, linked to some benchmark rate, then what we should do to hedge that is to buy a call, an interest rate call option. If interest rates rise, this thing will pay off, and it will help offset some or all of the costs of our more expensive loan. So let's take a tangible example of that and see how that works in practice. Here's the setup. You know you're going to owe an interest payment on a loan. That loan is variable depending on market rates, and you want to hedge it using a call option. Here are some parameters. You purchase the call on April 14th, but you purchase it ahead of time. this is another unique thing about interest rate options. They sort of kick in at a certain date later than when you actually purchase it. So you're buying the call now, as soon as you're planning a loan. And let's say that's April 14th, but you know that your loan doesn't start until August 20th. That's when you're going to select your expiration date for. The call expiration date is therefore going to be August 20th as well. And then finally, this is when the loan starts, and then this is when the interest rate gets decided on that loan. And then the loan is due 180 days later, February 16th, and that's when it's paid. That's when you pay off the loan plus the interest. And critically, this is also when you receive the payment from this call option. Another unique feature about interest rate options. You're receiving payoff later than the expiration date itself. The rest of the things are more similar to what you've seen before. We have a strike price. In this case, it's an interest rate though, and the strike rate is 5%. The notional amount that we're borrowing is 40 million, and so this is the notional amount of call options that we'll need to buy as well. And the cost of doing that, the premium for these call options, amounts to $100,000. So, one thing again to emphasize is that you're getting the call option now, April 14th, but you're not actually getting the loan proceeds. You're not actually doing the loan until sometime later, August 20th. So in other words, the call premium is paid early. And so we kind of need to account for that when we're considering the effective cost of using these interest rate options to hedge. We need to consider the time value of money. And so the call premium is $100,000, but we pay that early. And so what we can do to account for the time value of money is to bring that forward by LIBOR's rate. Well, that is LIBOR plus whatever credit spread we're going to have on this underlying loan. That's sort of you could say it's our cost of capital. So let's put that here. Our actual benchmark, LIBOR, when we purchased this loan, is 5.5%. I've purchased this call option. And our credit spread, the additional interest rate that stays fixed that we have to pay to the bank on this loan over and above LIBOR, is 2%. So these two together are 7.5%, and that's the interest rate on our loan as of April 14th. We don't know what it'll be later because it depends on LIBOR. The only component that we actually know that'll stay fixed is the credit spread component of that loan, the 2%. But because we are spending $100,000 on the call premium as of April 14th, and we don't, it doesn't kick in. We don't actually get the loan until sometime later, August 20th. That's 128 days between these two. Then we discount that $100,000 by that 128-day period at this annual interest rate of 7.5%. And so the effective cost is $102,667. Effective cost for the call premium. And once we know that, the effective cost of the call premium, we can figure out how much we're effectively getting from loan proceeds as a result of paying this money to put on this hedge. So our loan amount is $40 million, and we're spending effectively $102,667. So net what we're getting as far as a loan that we can spend and use, 39,897,000. So when we bought this call, this is what LIBOR was at. Let's see what happens to both our loan and the call option if LIBOR between now and the next 128 days actually rises to 8%. So we know that this will be good for the call option and bad for the underlying loan that we have. The loan will become more expensive, call option will produce some profit. But let's see by how much for each. First, note that this is a 180-day loan. That is, the borrowing begins on August 20th and ends February 16th. It's 180 days. The interest rate, though, gets triggered based on whatever LIBOR is at the beginning of this, and then that's the interest rate that you pay for a 180-day period until the payment is due. So if we just look at the cost of the underlying loan, the $40 million, we know that LIBOR has risen to 8%, and then we also pay not only LIBOR on this loan, plus the credit spread. That was at 2%. But both of these are on annual rates, and so we kind of need to de-annualize that by the actual length of this, which is a 180-day loan. And the net result is that there's going to be due a $2 million interest payment on February 16th. So this is our interest on our underlying loan. And it's more expensive because LIBOR jumped up. But let's figure out how much we earned from buying this call option. We made sure to get a call option that was the same notional value as our underlying loan. And we know that the payoff of an interest rate call option is the maximum of either 0 or the difference between whatever the benchmark rate is at the time, the underlying rate, versus the exercise rate that we selected for this option at the very beginning when we purchased it. It's like our strike price. But because both rates are annual and we have a contract that's not annual, it's 180 days, we have to de-annualize or scale down these two figures here. And so plugging our numbers in, we have, for the payment of this option, the maximum of either 0 or the LIBOR rate of 8%, the rate at the beginning of the borrowing date, which coincides with the expiration date of this option, and the strike rate that we agreed upon when we bought the option, the 5%. And it's 180 days, this option to expiry. And so we basically multiply by whatever annual rate this is by a half. And so this is 3%, this is 0.5, and so it's 1.5%, but 1.5% times 40 million is equal to 600,000. So the option paid off $600,000. The payoff itself, though, for both the option and the interest rate payment that we have to make doesn't occur until later, February 16th. So interest rate options are structured like this so that they kind of coincide with payment dates for the underlying loan that we have. But because we paid off $2 million in interest, and we also, though, received $600,000 from the call option, our net interest paid is a little bit better. Effectively, because of the call option, we paid about $1.4 million in interest instead of the full $2 million. And if we want to figure out the effective rate on that, that is effectively how much it costs us to borrow, then we can take that $1.4 million plus the $40 million that we paid, the amount of money that we actually borrowed, and compare that to the net proceeds that we received from borrowing after accounting for the cost of the call option. So we didn't actually receive $40 million in terms of borrowing. We received something less because we paid that $102,000 call premium. So if we want to account for that cost, then we can sort of compare the amount we have to pay back in the numerator versus how much we originally received up front in the denominator, and put this on an annualized basis. We only borrowed for 180 days, even if there's 365 days in a year. And that gives us an annualized interest rate after subtracting 1 of about 7.7%. And so this is really nice. This 7.7% is like, you can look at it as if it were a cap, the maximum interest rate that this company would have to pay on its loan. If LIBOR kept rising even further, then the call option would rise in value by just as much. And so the two continue to offset each other. And so that's why this 7.7 can be thought of as a cap here. However, the nice benefit is that if LIBOR falls, then their loan becomes cheaper. But if LIBOR falls by a lot, the loan becomes a lot cheaper, and the option eventually, as LIBOR dips below 5%, becomes worthless. And it's not a liability, it just means that it's worth 0. That is, it's not a cost to the company. They can just walk away from the call and just be out the call premium. And this is kind of like this asymmetric hedge in a good way, because on the high end, the company faces no higher interest rate. Even if LIBOR goes higher, the company is still protected against any rise in the cost of the loan. But if interest rates instead go lower, the company doesn't have to pay the full 7.7% that we calculated here. Instead, as benchmark rates fall lower, they just walk away from the option and still enjoy making lower payments on their LIBOR-linked loan. And that's one of the nice features about using options to hedge interest rate exposure, is this asymmetric payoff profile, asymmetric benefit.